Hi guys, my name is Tom and welcome to this week's video on what is an option's expiration date. Over the course of weeks and months, we're going to teach different option terms, strategies, and techniques to our viewers. Our ultimate goal is to educate you about the wonderful and highly profitable world of option trading. As always, don't forget to click the link and subscribe to this page. You'll also receive alerts when they are posted. Don't forget to follow us on social media and also check out our website. So let's jump into this week's topic. What is an option's expiration date? Before we do that, let's just do a quick refresher on what is an option. So options are contracts that give the bearer the right, but not the obligation to either buy or sell an amount of some underlying asset at a predetermined price at or before the contract expiration date. Option contracts are financial agreements between two parties to facilitate a potential transaction on an underlying security at a set price called strike price prior to an expiration date. When you buy an option contract, you can choose to either exercise your option contract on or before the expiration date or simply allow the option to expire unexercised. Options are an example of a derivative. A derivative's price is dependent on or derived from the price of something else. One option is called a contract, and each contract represents the ownership of 100 shares. Now, what's an expiration date? You hear this all the time. Well, an expiration date is the last date an option contract is valid. The investor, on or before this date, will have to decide what to do with their expiring position. Before an option expires, its owner can choose to either exercise the option, close the position to realize their profit or loss, or let the contract expire worthless. Expiration dates vary depending on exchanges and derivatives traded. The expiration date for listed stock in the United States is normally the third Friday of the contract month, and we're going to jump in and show you that, or the month the contract expires. So once an option contract passes its expiration date, the contract's invalid. It ceases to exist. The trader must decide what to do with the option before the last trading day. So we're going to have a look at what it means to own a stock and what should you do as it approaches expiration date. So that's important because there's three things. Your option is going to be in the money or out of the money. That's it. If it's at the money, it might be, if just a little bit in the money, it's a little bit in the money, it's a little bit out of the money. So let's look at what happens if it's out of the money and look at what's in the money. So if the underlying security is below the strike price, in the case of like a call option, at expiration, the option will expire worthless. So if you have a strike price of $10 and then the underlying stock price is $8, approaches expiration, and it's a call, therefore 8 is below the 10, it's worthless, then, it ceases to exist, you let it expire worthless. However, if the underlying security is above the strike price, the option can make two things. So it's in the money, it holds value. The in the money will be reflected in the options price exchange, and I'll show you this. The holder can either sell the option and lock in the value and hold on to lock in the value and make a profit, or they can exercise it and choose to buy 100 shares of the underlying stock. Let's continue. If you sell an option contract before expiration date, the profit is simply the difference between the price you paid and the selling price. That's pretty simple. You paid $50, you sold it $60, you made $10, less the commission fees, obviously. If you hold on to the option contract and it's in the money, this is the most important thing about this whole presentation. So if you hold on to this option contract and it's in the money, normally brokerage account will have an automatic exercise provision, meaning they will automatically exercise options contracts if they're in the money at the time of expiration. And I say that it's extremely important because let's look at an example. Let's say you hold an Amazon contract. Amazon is a very expensive stock in regards to the price of an individual stock and expires in the money. Yes, in the money. You will need to pay, if you just have one options contract, you will need to pay 100 times the strike price of that options contract. And let's say if the strike price of Amazon is $2,000, I think it's a bit more than that now, you will need to pay $200,000 for that contract. I want to stop because you need to be aware of that. Options enable you to trade, expensive stocks that are cheaper. But if you're made money, you're going to make sure that's in your brokerage account. You can satisfy that contract agreement. If you don't want to exercise the option contract, then you must close out and roll the position by the last trading date. I say automatically exercise. Normally, and I'm not going to say this for all brokerage accounts, but you can change the default setting for options contract depending on your brokerage account. But to my knowledge, most brokerage accounts will have the default feature that they will automatically exercise it. I'm not going to say for everyone, but you need to check that if you're going to be heavily trading, because that is something that can get you quite tricky and get in a lot of trouble. So let's jump into a brokerage account and let's have a look at expiration dates and what it actually means, and in the money, out of the money, and just look at those dates. So we've jumped into our brokerage platform, and what we're looking at is an option chain for the automotive company Ford. And what we're going to do is we're going to look at expiration dates. This video focuses on these dates at the top. So like I said, expiration dates is the last day that an option contract is valid. So this day here expires today, meaning all these option contracts above and below will expire today. These ones expire in 28 days, 112 days, 203, 511, so forth. On or before this date, the investor will have to decide what to do with their expiring position. Before an option expires, the owner can choose to either exercise the option. So you purchase this option contract right here at $6 and say you want up to $10. You can choose to exercise it straight away. You don't have to wait to the end. Exercise it, then you own. If you have one contract represents the ownership of 100 shares, you would then own 100 shares of the underlying Ford stock. You can also sell it because it's going to increase in value, locking in the profit. And then the third one is it doesn't do it. You bought an option contract here, $6, and you thought it was going to go to $8. And it didn't. It stayed below $8. These ones are worthless. They have obviously have no intrinsic value. They now have little to no extrinsic value because it's going to expire today. They're worth nothing, and you're done. You can't even sell it for anything. However, if you hold one in a month's time, they still are worth something. Not much. They're still worth something. So and the reason they're worth something is because they still have a little bit of extrinsic value by the way of time value. They still have enough time, and then to hopefully maybe Ford might have a big jump in stock price and get to that $8 that we talked about. So if you have big companies, they'll have a lot of expiration dates. But if you have small companies, then they might have that large range. Let's look at maybe, here we are, Office ODP Corp. This one only has these expiration dates. And the reason that is, it's just traded less. Compare that to, I don't know, let's look at maybe Google. Look at that. Hundreds and hundreds of expiration dates. So it just enables you. The biggest thing is you can take away from that is, the more well-known, more traded the companies, they have the wider variety. And the biggest takeaway from expiration dates is knowing what to do as it approaches date. The further away an expiration date, the more expensive the option contract will be. Why is that? Because it has more extrinsic value by the way of time value. Therefore, the premium, which is just factored into the price, the premium will be more expensive. The closer in, the less time value, the less extrinsic value, the less premium will be cheaper. However, the chances of you making money, especially if it's out of the money, are going to be less. So that's expiration dates. Thank you so much for watching this video this week on what is an option and expiration date. If you like this page, please check out our website and click the link. Please also don't forget to subscribe to our page and also check us out on social media. We love to hear from you. Stay tuned for new content next week. Thank you so much. Bye.